done.
All right, so we continue with chapter 1. You gotta completely zoom out, right? You're completely zoomed out, right? For chapter 1. And on chapter 1, I was last time reached up to embedded options. So I covered what's called the call provision. And call provision is very simple. The issuer can call the bond at any time, meaning can call it sooner and pay you back. Okay? Now, why would the issuer want to do that? They will want to do that for a very simple reason. You're paying right now 10% interest on your bond, and interest rates fell to 5%. And as interest rates fell to 5%, you say, hey, why should I be paying 10 when I can pay 5? I'm going to issue a brand new bond paying 5, take the money from the new bond and pay back the old bond. Now, this is great for the issuer, but it's not good for the bond investor. And you also have the so-called, let's see, put provision. And the put provision is the exact opposite. In a put provision, the investor at any point can return the bond back to the issuer and get his cash back. That's tremendously favorable for the investor. Let's see what else. We have convertible bond. Convertible bond is called a hybrid instrument. Hybrid. Hybrid means that it has the characteristics of both debt and equity. So every hybrid instrument has debt characteristics and equity characteristic. The debt characteristic is the bond part. The equity characteristic is the convertible. Convertible means that the bondholder can convert the bond into a fixed number of stocks at his choice. So you got a bond and you can change it or convert it to 50 stocks. Okay. This number of stocks is called conversion ratio. And conversion ratio gives you the number of shares that you can get for one bond. It could be 10, it could be 20, it could be 100. What does it mean? It means that as the price of the stock goes higher and higher and higher, the value of the bond goes higher and higher because you have the option to convert the bond into stocks. Let's provide an amazingly simple, high school example. Conversion ratio, let's call it 50. The price of the stock is 10. If the price of the stock is 10, the conversion option is worth 500. Actually, the conversion value is 500. If you convert now, you get 500. But the bond is worth 1,000. So the option has very little value. Now, as the price of the stock goes to 15, now the value, when you convert 50 shares times 15 is 750. Still, you will not convert now because the value of these 15 shares is less than the value of the bond. Now, gets interesting when the price of the stock gets to 25. If that's the case, you have the value of the 50 shares equal 1,250. And the bond is worth about 1,000 without the option value. So you're better off converting the bond now into 50 shares and gain an extra 250. Okay? You can cash in now. Well, that's basically the value of convertibility. It's called convertibility option. If the price of the stock rises enough, you get to benefit from converting. Okay? And that's what it is. That's simple as that. Next one is called exchangeable bond. All right, so what is exchangeable bond? And you're zooming out, right?
Mm-hmm.
You're zooming out completely,
Mm-hmm.
right? So what's an exchangeable bond? It is just like convertible bond. The bond can be exchanged into a fixed number of shares of another company. So a convertible bond of IBM will exchange into a fixed number of shares of IBM stock. But an exchangeable bond will be converting a fixed number of shares into some other bond, some other stock, to the stock of some other company, not the issuer's own company. So convertible of own shares, exchangeable of other company shares. That's the key difference. Describing bond issue. I'm still now on page 6. You should be able to follow on page 6 in the middle. And the bond is described with what's called a CUSIP or a CUSIP number. CUSIP or CUSIP number. It's basically an ID of the bond. It will tell you who is the issuer, when is the bond maturing, maybe the month of maturity, maybe a few other things. It's a 9 or sometimes 12 digits or 12 characters. It basically identifies uniquely a fixed income instrument or a bond. That's how you know exactly what it is. So every specific issue will have its own CUSIP number. It is the ID, the way that everybody in the world recognizes this bond by its CUSIP number. What's the advantage? Well, the advantage is the same as knowing everybody, the whole world knows your name or knows my name. Based on my name, I got my diploma, my job, my salary, my bank account. Everything in my world centers around my name. Well, here for the bond, the main advantage is market liquidity. It is a little better traded if everybody, when you're buying and selling, you're sure exactly which bond you're buying and selling. So it provides you unique identifier. When we're trying to buy and sell, there is no mistake. If we both say what's the CUSIP number, we're absolutely sure which particular issue we're talking about. All right? So the CUSIP number benefit provides certainty about the identity of the financial instrument. You know which is the financial instrument. And therefore, people know they're going to be a little bit more willing to buy it, sell it, trade it, make market on it, and so on. Section number 3. That, of course, is the big section, the most important for this chapter, which is going to be next time. It's about risks associated with bonds. We can just call it for short bond risks. And while there may be 20 or 30 different types of risks associated with bonds, we'll simply begin with the 9 which the textbook gives us. So number 1 of these is interest rate risk. And interest rate risk is very simple. When interest rates, we are looking here on page 7, in the middle of the page, risks associated with investing in bonds. The first risk is called interest rate risk. All right? Interest rate risk is very simple. When interest rates rise, and by this in finance we mean yields rise, the price of a bond goes down. When interest rates fall, the price of a bond goes up. This is the so-called inverse relationship between prices and yields. Let's write it out in basic notation. So the price of a bond goes up whenever interest rates go down. Well, what's the risk for the investor? The risk for the investor is that interest rate will go up and the price of a bond goes down. It's that simple. So, bond investors face the risk that general interest rates will rise and the value of their bonds will be falling. That's interest rate risk. That's it. Number 2, reinvestment risk. Reinvestment risk basically means that as you are getting your coupons paid, so you got a 10-year bond, at the end of the first year you get a coupon payment, at the end of the second year you got a coupon payment. Your coupon payment is a generous 10%, and when you get your second coupon payment, the interest rate is only 5%. And this means that when you try to reinvest that coupon at 10, you can't. The best you can get is 5. So reinvestment risk is the risk that as you get your cash flow from the bond and you attempt to reinvest it, you're not going to be able to get your original yield. In other words, the reinvestment risk is the risk that yields will fall, and when you try to reinvest, you're going to be getting a lower yield. It's that simple. Let's see what's next. They have, and it's not the time and effort now, it is part of bond investing in portfolio strategies called immunization. To immunize your portfolio is basically a technique, a strategy to mitigate, meaning to lessen or lower that reinvestment risk. Not the time to discuss those strategies now. Number 3, call risk. It is actually exactly the same as what happens with mortgages, and in the mortgage world it is actually a well-known problem. So I'm going to put a nice big equal sign, which is the same as, let's see, prepayment risk. Prepayment. Again, this little dash means the same as above, risk. So what's prepayment risk? Well, in this particular case is a call risk, is you're getting a juicy 10% interest rate, interest rates fall, issuer decides to call back the bond, they call back the bond, you get your cash back, which was earning you 10%, you try to reinvest, you get only 5%. So this call risk is also in intimately related and associated with the reinvestment risk. The reinvestment risk is difficulty to reinvest the coupons that you get. Call and prepayment risk is the risk that not only the coupons, but also the principal you can't properly reinvest. Okay? So they pay you back the whole thing and you can't invest it well because the general interest rates in the economy have fallen. That's 3. 4, credit risk. And credit risk is simply the risk of default. And it is quite commonly called and known as default risk. They are the same, you just use 2 different words, 2 different terms. Default. Default risk. What is default? Default is, from last time, that the lender does not get his payments on time and in full. So if they can pay you only partially your interest, that's default. If you can't pay today, but they have to, gotta take a few days later, that's default, okay? Default does not necessarily mean you don't get your money back. Means you can't get it all on time, okay? That's still a default. So credit risk, let's see, or default risk, first of all, is evaluated by what is known as a credit rating. And I did it last time, I think. Credit rating is an evaluation of the likelihood or probability of default. A better way of saying it is an evaluation of the creditworthiness of a borrower. Creditworthiness. Creditworthiness means ability to service debt, ability to generate sufficient income in order to pay back your interest and principal on time and in full. So creditworthiness is the exact opposite of default. If you're creditworthy, you won't get in default. If you're not creditworthy, you're more likely to get in default, okay? And creditworthiness is measured by the credit rating, okay? And the business, it is actually an institution. The business which generates or creates or calculates these credit ratings are called ratings agencies, sometimes credit ratings agencies. So, ratings agency. Is a business which specializes in evaluating the creditworthiness of the borrower and providing credit ratings for particular debt issues, right? The next key idea here of credit risk is called credit spread. And credit spread is the premium, meaning the increase in yield or the increase in return to compensate for credit risk. So, if the risk-free interest rate is 4% and you're very, very, very low risk, you're going to be paying me a credit spread of 0.5%, which means you're going to be paying 4 plus half, 4.5. you're a higher risk, you're going to be paying 5. And if you are a terrible risk, you're going to be paying a spread of 6, which means 4 plus 6, 10. So credit spread reflects the credit risk, and if the credit risk is higher, the credit spread will be higher, and therefore the yield will be higher. This corresponds to the most basic, most elementary financial relationship that you study in the second week of finance, which means higher risk means higher return. In this particular case, we say higher required return, or higher required rate of return, which is the same as yield, okay? So that's the basic relationship. What's next? Credit spread, widening credit spread, risk, okay. Next is, actually, that's part of this whole story. It's a separate risk sometimes. It's called a downgrade risk. Downgrade risk. Downgrade means to lower the credit rating of an issue, of a particular bond. So credit rating is, let's say, A, and becomes B. Just recently, a month ago, the credit rating of the United States was downgraded. So downgrade basically means lowering the credit rating of a particular issuer, a particular issue, more correctly. And downgrade risk is simply the risk of downgrading. So you buy a AAA bond, like China has been doing for the last 10, 20 or so many years, buying these American bonds, and suddenly they're suffering the shock of a downgrade. In other words, there has always existed a downgrade risk. But the downgrade risk last month materialized. Downgrade came for real, okay? Now, downgrade risk does not necessarily mean immediate loss. Downgrade risk simply means the credit rating is a little lower and the likelihood or the chance of a default has become a little bit higher. Okay, that's a whole different subject I don't want to get into now. The U.S. government doesn't have to default necessarily by stop paying. They can default through inflation. They inflate the money supply, they inflate the price level, they lower the purchasing value of the dollar, and they pay you back with cheaper dollars. You got screwed anyway, right? But there's a different way of doing that. In other words, you suffer the loss not by not getting your money back. You got the money back, but the money's worth less. It buys less gold, it buys less barrels of oil, less wheat, less rice, less watches, buys less of everything. You lost the value of your money. Well, that's purchasing power risk, which is coming very, very soon. Yeah, number 5, inflation risk. Well, inflation risk runs actually two ways, two different effects. Inflation risk means two things. Number 1, inflation rises, and because inflation rises, the required rate of return rises. As inflation increases, interest rates or yields increase. And if interest rates and yield increase, price goes down. Okay? So, because inflation goes up, that's so-called Fisher equation. And Fisher equation is amazingly simple. The most elementary which you study at the beginning of finance is that interest rate nominal, meaning nominal interest rates, equal real interest rates. So IN, nominal interest rate, equal real interest rates, plus, let's just call it inflation. Inflation premium or compensation for inflation. Okay? So, if inflation goes up, rising inflation causes nominal interest rates to rise, and this rising inflation translates into rising interest rates and transforms into interest rate risk. So, one of the fundamentals to understand, it's very difficult. That's the very hardest part of finance, is one type of risk morphs and changes into another type of risk. Here, the example is how inflation risk morphs and changes and realizes into higher interest rates, into higher risk. Now, that's the one type associated. The other type associated with inflation risk is known properly and separately as purchasing power risk, sometimes shortened for PP. PP standing for purchasing power risk. And purchasing power risk is exactly what I explained a few minutes ago with the United States, where the US will inflate the value of the dollar, the price is the dollar, and the purchasing power of the dollar falls. So when you eventually get your money back, 1,000, when you get them 10 years later, now your $1,000 will buy you 11 barrels of oil, then they'll buy you 8. So you have a loss of 3 barrels of oil purchasing power. Okay? That's simple. So purchasing power risk. So when inflation goes up, inflation is a bitch for investors. It's a killer for bond investors. It kills you one time because interest rates rise and prices go down, and it kills you a second time because your money, whenever you get it, is worth less. So you lose twice on your money. That's why it's a terrible thing. Okay? Next, 5. Okay, 5, 6. I shorten it for all of you. ER, that's not emergency room, the movie that you're watching, right? That's exchange rate. So, in this course, for the rest of the course, usually, for all courses in economics and finance, we use IR to indicate interest rate, and we use ER to indicate exchange rate. So, interest rate, exchange rate, okay? So, exchange rate risk. Well, what's exchange rate risk? Very simple. You buy a particular bond, whether it's a Japanese bond, or American, or Russian, and the exchange rate of the currency in which the bond is denominated falls. So buy a Russian bond in Russian rubles, and the ruble falls. And when you convert it back to Chinese yuan, or what is it, New Taiwan dollars, the result is a loss because the currency fell. Well, that's exactly what happens today with investors, because the value of the US dollar is falling. China kept buying for 10, 20 years those US bonds, and now as the dollar falls and falls and falls and falls, the exchange rate risk has actually materialized, and China suffers exchange rate losses on its bonds. Okay? So that's a separate type of risk, okay, which you have. Next, liquidity risk, 7. Liquidity risk basically means that liquidity will go down, or liquidity can practically evaporate. In other words, is the risk that the liquidity of the particular bond falls, and as a result, you cannot get a good price. Last time I gave you the example of my watch, which is very illiquid, very hard and difficult to sell. Well, here the risk is that you're buying a liquid bond, you think it will remain liquid, but 1 or 2 years later when you try to sell, the market, for whatever reason, is not as liquid. The extreme case is called the market is freezing. When the market freezes, there is no liquidity, meaning there is no buyer. You try to sell it, nobody in the world will want to buy it for whatever reason. They're scared, there may be a whole bunch of, maybe a revolution, there may be a nuclear detonation, there may be a war, right? You bought a bond, the country got in the war, said, oh my God, they won't be able to pay my bond back. As a result, suddenly buyers disappear. We say liquidity disappears, okay? And this means that the price will necessarily fall, okay? Well, that's what we say, that bonds have a liquidity risk and therefore a liquidity premium. When you have a high liquidity, the liquidity premium is low. When you have a low liquidity, the liquidity premium is high. When liquidity goes down, the premium goes up. And as the premium goes up, the yield or the return goes up, and this results in the price going down. That's this basic relationship. So, interest rate, which is the same as yield, has a default component. It's also got an inflation component. It's got a currency component. Exchange rate is the same as currency. And also got a liquidity component. So if any of these deteriorates, the overall yield will have to rise to compensate. And the overall yield rising is the same as price falling. Next one is volatility. Let's see. Volatility. All right. It is a basic premise in finance that volatility determines the value of an option. Higher volatility means higher value of an option. Lower volatility means lower value of an option. No volatility means constant price, means zero value of an option. So the value of an option goes up with volatility. So bonds have embedded options, which I was just teaching. They got a call provision, which is a call option. They got a put provision, which is a put option. They got a convertible bond, which is both at the same time a put on the bond and a call on the stock. So all of these options will be based and valued on some volatility. If the underlying volatility goes up, it will affect the value of the option price, of the option component of the bond. So we cannot say it goes up and it goes down because we don't know whether the component is a call component or a put component. Whether the volatility, rising volatility may affect positively the investor, it may affect negatively the investor. So we just leave it at there. And the last one is called risk. Risk. And risk is basically what is well known in finance and in the literature as the unknown unknown. In other words, you have a certain bunch of risks, a whole bunch of them. you actually know what these risks are. I just gave you like 8 or 9. You got a liquidity risk, but there's a whole bunch of other risks which we don't know. We don't know. There may be a nuclear war going on, okay? We can't estimate one. There may be an earthquake, natural disaster. Again, we can't possibly know all the risks in the world. And this risk is the risk that we don't know about, that we can't estimate. This correctly and technically is exactly the same in the modern, actually the classical theory of finance, as uncertainty. All right, let's explain now the difference between risk and uncertainty, because for finance students, especially for finance professors, it's all too easy when asking what's risk, and they say, oh, uncertainty. No, no, no. These are two different beasts. Risk is a probability of things going bad or wrong. In risk, you can actually estimate the probability. You know what the chances are. You know that the chance of dollar devaluing is about 10%. So in risk, you got a probability and you can estimate the problem. You got a good idea of what it is, okay? In uncertainty, you have no idea. We still don't know, as sophisticated as we are, the probabilities of how to estimate the probability of major earthquakes, just like we had one in Japan 5 months ago, okay? So that's total uncertainty. Now you got an uncertainty on top of another uncertainty. Just because you had a giant earthquake, all right, doesn't mean that nuclear is going to go bad. Then the earthquake caused flooding. Well, you can't really estimate what's going to be the tsunami and the flooding coming from the ocean based on the earthquake. And then there was yet another uncertainty. Just because you have a flood doesn't mean that the nuclear reactor cooling system is going to fail. All right? So you have 3 events, for each of which you have no way to estimate what's the likelihood, and they add up on top of each other. Well, that's pure uncertainty. All right? Pure. These are estimable, and uncertainty is not. This is good enough for now? All right? Okay, we're done with this lecture. 10-minute break.